This is the London Fintech Podcast, bringing you practical insights and approaches, stories and inspiration from the innovators who are building the new world of financial services. This podcast is brought to you by NextWave, strategy specialists and solutions for financial institutions. I'm Tony Clark, and this is the London Fintech Podcast. On today's episode, we're going to be talking about the world of private credit, and in particular, fintech lending with Francesco Filia of Fasanara. Private markets, and we're talking private equity, private credit, real estate, infrastructure, and other alternative asset classes, essentially everything that's not listed equities and bonds, have attracted a lot of attention recently, with investors, advisors, and institutions increasingly looking to take advantage and to source and to operationalize access to the many diverse investment opportunities. So within this space, private credit, which is essentially non-bank lending to private companies, is itself a market of circa 1.5 trillion assets under management, and it's growing quite fast. Unlike listed markets, the investment opportunities tend to be localized, bespoke, and either at one end, really large loans which are reserved for institutional investors, or at the other end, structured in small ticket sizes that can't be meaningfully invested in by the big guys. It's the latter problem of sourcing and aggregating private credit opportunities for institutional investors, which Fasanara is solving in a very neat digital approach, as Francesco will undoubtedly explain in the next few minutes. So Francesco is a derivatives specialist who I understand left Merrill Lynch in 2011 to establish a hedge fund. And in 2013, he came across the market of fintech lending, so named for the way these loans are originated by digital technology, as opposed to traditional commercial banking. Francesco went on to create Fasanara. So welcome to London Fintech Podcast.
Hello, Tony. Good to be here.
Yeah, it's good to see you. So it's a really fascinating area. And before we really get into private credit, let's just start at the beginning. Can you tell us a bit about you, early influences, early career, and how you got into the derivatives and hedge fund space?
Well, I'm Italian. I lived in London now 26 years, so like half of my life. Actually, a little bit more than half is spent here in the UK. So I guess I'm also half British now. I started studying in Bocconi University in Italy, and from there I moved into working in banking in JP Morgan first in 1997. As an analyst. Then I moved to Merrill Lynch as a derivative specialist, and I spent 11 years at Merrill Lynch. So I was in banking between 97 and 2011, the year in which I left Merrill Lynch to set up Fasanara Capital as an hedge fund. Derivatives came about as a love at first sight. Let's say I utilized what I had learned at JP Morgan in research. And to implement my technical skills to be able to handle the derivatives. My time, it was called swaps marketing. It was really about packaging up derivatives and selling them to corporates for the purposes of asset liability management. So hedging their FX exposure, their interest rate exposure, doing exotics on top of things, et cetera, et cetera. And I guess it came natural to me because the previous experience in research was very theoretical, was very high level, and the derivatives was very much about making your hands dirty in business and trying to utilize that knowledge base to actualize investment opportunities, trades, and profitability for the bank. Derivatives was also a very composable business, so it's a modular business where it's about building blocks one on top of another. It was a segue into a lot of creativity, there are multiple ways in which you can package up a derivative for a single client. And so that freedom, those degrees of freedom were leading to a lot of fun during those years. And then, of course, the derivatives at the time were very interesting. Then the market changed on them. Regulation changed, accounting rules changed, and it was not as easy for end users to use them. And therefore, the market moved on. And at some point, I felt compelled to leave banking to set up my own shop.
Yeah, I can see that experience with the major institutions of packaging and structuring deals. I can see how that will come through into creating the Fasanara platform. And we're going to get into that in a few minutes. And I always like to ask, just before we sort of unpick the current initiative and your business, just a bit more about you. When you're not working on Fasanara, what's your downtime? What do you like to do to unwind?
Well, I've got 3 kids. So 3 boys, young boys, 12, 11, and 5. So when I'm not working, I'm busier than ever. So like I have to dedicate time to that, and I've got a very strong wife. So typically when they say, "What do you do on a weekend?" I say, "I do what I'm told." So I follow instructions. Very diligent at that. And apart from that, I like looking at boxing and kickboxing, in terms of combat sports. I used to do that as well. Now I'm too old. My bones are too fragile. But I used to like to do it as well many years ago. And I like to look at many other things. I like to read a lot of all subjects, and random reading, I call it, because it's really without a specific subject of choice, but it's quite broad ranging.
Okay. Well, we'll come back to that. I think as we wind up later on, I'm curious about what you're reading or listening to. So we'll come back to that question. That's great. And we've had horse riding, scuba diving, and now kickboxing on this show from various guests over the last few months. But I recognise the point about spending the family time. I have 2 boys, and practically don't have any downtime at certain points. So echo that. Okay, so what prompted you to leave behind and take that leap into entrepreneurship? What was the tipping point to say, I'm really going to do my own thing now?
It was a couple of things. On the one end, it was like a personal, my own personality didn't fit that well with the very large environment, like a global investment bank, like Merrill Lynch, was also quite aggressive in terms of style, and politics, internal politics, they did matter, right, to advance in your career, which I was not absolutely good at. I was more product focused and more looking at my production cycle. And that didn't fit well, although I had a great run, right? And I'm super grateful about what I learned back then. At the same time, I also learned a lot of things that I didn't want to export, right? So the culture of more stua vita mea, like a very aggressive culture, didn't really fit well with what I wanted to achieve outside of it. And so these definitely played a role. On the other end, also, I thought that the banking business was a bit on a declining path. I thought that the best years were past, the years of creativity, where the technology really happened at the level of the bank, the investment bank, that was at the frontier of the cutting edge technologies created back then. And again, I speak about derivatives, I speak about exotics and stuff. So I felt also the learning curve was going to flatten out from there. And so those 2 things together led me to think about setting up Fasanara Capital together with Pietro, my colleague back then at the time of Merrill Lynch, that was really pushing me out. So he convinced me to leave the bank to set up our own company. And that was the beginning of the journey. And that was April of 2011.
Okay. So it's interesting that sort of cultural fit or misalignment that you were feeling perhaps. And I'm very interested as I'm talking to a number of inspirational folks on this show as we go forward, what the big banks are going to have to say about the observation about innovation or lack of in the banking sector. I think everything goes through cycles, and I say that there are some big firms who certainly would say that they're being very innovative, but totally recognize the triggers for your departure to do your own thing. And I presume no looking back. But what's in the name? Fasanara is an interesting name. I'm wondering what that means.
Well, and you're right. I'm sure banks wouldn't agree to a single word of what I said. And banks are also big partners of ours these days, right? So I speak my mind, but I can totally see that sometimes I go all on one side. Fasanara means place where you go to hunt the pheasants, etymologically. And it is the name of a little area in my hometown, which is a city called Ferrara in Italy, not far from Bologna and Venice. And in this little area, the ancient book name is Fasanara. And it indicates the area in which the royal family from the city-state of Ferrara, back during the Renaissance and the Middle Age, used to go to hunt the pheasants. So the birds, the pheasants. And so it's a hunting ground for the royal family of the city-state in the ancient books. I'm pretty sure that my own, the people living in Ferrara don't even know about that. They know that there is a little bed and breakfast these days that my family owns in the place, but I'm pretty sure the name is not known even locally for this. But given the fact that in 2007, during the times of Merrill Lynch, I had invested for my family in Ferrara into this boutique hotel, which is a bed and breakfast, a very small bed and breakfast in the city. And given the fact that this bed and breakfast was called and is still called Fasanara, Orti della Fasanara, and the idea came about to give the same name to the hedge fund. And actually the idea belonged to my colleague back then, my co-founder, Pietro, that said, why don't we call it Fasanara as a way of joking around? And so in the end, we call it Fasanara. And I think the name brought luck. People tend to smile at that because it's a funny name and then nobody knows what it means.
Yeah.
And it was also, the idea was also to create, of course, an hedge fund, which is like an operation which targets performance, high pace, but at the same time, not give it such a, bloated name like Apollo, Centaurus, Cerberus, BlackRock, that these are very, like, if you want aggressive names, or very, and so give it a more like colloquial name that would be a bit more easygoing. And so it worked because, it was very much liked by the investor community.
What a great story. I mean, most company names have a story behind them, but I didn't think I'd be talking about, ancient royal hunting grounds and investments in boutique hotels. So I really like that. And it's a great name. I heard it. I thought it has a bit like fascinating, and I'm sort of slightly fascinated by the business. So that's a good link to talk about it. So let's talk about Fasanara a bit. Clearly set up the business to address a gap that you see in the market. So essentially problems, opportunities relating to the traditional asset management industry, a gap that Fasanara is filling. So can you tell us a bit about that? What's the industry opportunity that you're addressing here?
Absolutely. And just to frame it, Fasanara is a digital finance asset manager. So we look at everything that is digital. We want to be the next generation asset manager, utilizing technology to implement investment opportunities and building technology at our end internally in order to enable those investment opportunities. So that means two things, fintech and blockchain. And these are the two souls of Fasanara. So we manage $4.5 billion today, over 100 people based in London, headquartered in London. And then blockchain means trading and high frequency trading, market making, whereas a fintech means loans, means lending to the real economy via a network of fully integrated fintech lending, non-bank lenders platforms, which are scattered across globally. Today, Fasanara counts over 140 fintech originators in 60 countries, which are integrated into the Fasanara technology and through which we lend to the real economy, either businesses or consumers. So either businesses, which are typically SMEs, small and medium enterprises, or individuals, consumers. So we do business finance, consumer finance. We also do real estate finance. We also do sports lending. These are all different verticals within what we call fintech lending. And fintech lending is really all that lending which is non-bank and happening through a technology platform. So we fully focus on that, and we developed an in-house technology proprietary in order to be able to deal with this. We recently also went through a transformation where a big component of this technology firm was going through a round. Blackstone also invested into it. We're very, very proud of it. But that is like a testament to all the technology that we were able to look at in order to enable our work at direct lending, the real economy, intermediated by these platforms all across the globe.
So, and we'll get into this a little bit. The challenge with the non-bank lending, as I understand it, is that many of these deals are localized, small. There might be lots of them at small ticket sizes. And essentially what Fasanara is doing here is aggregating and providing a platform to bring all of these loans onto platforms so that your investors can invest in your funds at scale and have exposure to those lending deals. Is that right?
Correct. So on the one hand is how we source the capital at our disposal, and that is through asset management from institutional investors. Those are pension fund, insurance companies, and banks for the most part. 95% is institutional capital. That capital is invested into our own funds. Our own funds, they deploy that capital into very granular loans. So loans of a very small ticket size, 50,000 to 500,000 is really the range in which, for the most part, they sit. And these loans are originated for our review and selection by a number of fintech platforms globally, which are the fintech lending platforms or digital platforms, as they're called. These are typically very localized in a single country, in a single asset class. They can be like, for example, Italy for invoice discounting and supply chain finance and receivables financing, or it can be like Germany for consumer loans. It can be one platform in the UK for merchant cash advance, point of sale financing, buy now, pay later. So they vary. And our job is to accumulate them, aggregate them, integrate them, be able to analyze what they do through API connection, through our dashboards and analytics, be able to rate these loans and check the health of the portfolio over time, and then provide effectively what is a very diversified pool of short-dated loans that allow these institutional investors to get a good return on capital on a very short time horizon. And so for the capital to self-liquidate and then be renewed into new loans from which they can clip a new coupon. It's interesting because it's got to do with the real economy. So it's not speculating up and down on public stock markets or bond markets. So it's real companies, real people. So it's great because it hits a social target, I guess, and not just speculation for the sake of it. It's great also because Fasanara focuses on short duration assets. So 3 to 6 months is the bulk of our portfolio. And so this portfolio self-liquidates. So it's always to be retweaked and retrained. And so we can always change directions if we see trouble at the horizon. And it's great because the yield that they can get on these portfolios is very meaningful. It's goes anywhere from 6 to 15%, depending on the level of risk that they're prepared to take. And so it's a good return for a very good level of risk, diversified and short duration. So it is for a good purpose or at the same time.
Yeah. And so just walking that through, so your originator, say, could be, I think you said an invoice discounting company, for example, and I don't know what invoice discount rates might be at the moment, but I wouldn't be surprised if they're sort of 1.5%, 2% a month or something. And so there's your sort of 15%. And those loans are originated on the invoice discounters' own technology and platform to their client base, which will be multiples of businesses that are on the platform. And then you're providing capital into that lending and aggregating that loan on your platform to expose it to the end investor, the institutional investor on the other side of the platform. And this is all on your technology. I think that's right. Okay.
That's exactly correct.
Yeah.
That's exactly correct. So we do what is called otherwise a private credit, asset-based lending.
Yeah.
So asset-based lending because we lend against the value of our collateral. The collateral is the pool of loans that we acquire and we select from the individual originators. Typically, it's done through the setup of an SPV that is under our control and that collects all of these loans, and then we lend against the value of this collateral. We sometimes align the interest with the platforms by having a tranching of this collateral. So within the SPV, we have a senior and a junior. And Fasanara will be the senior. And so we also align the interest by doing that, and we decrease the risk and we mitigate the risk. Should a recession occur or should a credit cycle occur? But that's
yeah. And so what trajectory is Fasanara as a business on, and this fintech lending part of the sector? What's happening out there? Are other people doing the same thing, or are you guys feeling that you're pretty much in a niche here?
Well, we are in a niche because it's still a niche. It's not like a mainstream yet, but we do have tons of competitors and players that we also partner up with at times. Today, there are people so we manage a 4.5 billion. We have a lot of people between 1 and 3, 4 billion that they've been in the market for quite some time. We think we've been like a kind of pioneers because, we started this in 2011 and the first trading happened in 2013, 2014. So we have been almost 11 years in a full track record, audited in open-ended format. So very also established. There are other people that have been there several years and that they've helped build this space and ecosystem. More recently, in the last few years, we also had the entry from the big guys, especially the mainstream established players in the US, from KKR to Apollo, Ares, Bain, M&G, all the big guys. And so that has created even more attention for the asset class, has established the asset class as a proper allocation of capital. I would say that still early innings, because still is a lot that needs to be built up. But definitely now we move into Fasanara alone, 4.5 billion, together with the co-players. This is probably something in the 20, 30 billion area already. I think it's moving fast. It's in exponential growth. Every year there are new platforms coming to the fore and offering their loans. Of course, a lot of platforms also cease to exist because it's a dynamic process of creation and destruction. but that is only natural. But I think that every year the market is bigger than the year before and is moving at an exponential speed. So I would imagine in 10 years from now for this to represent a lot bigger share of the pie. There is an underlying trend, which is the decentralization from commercial banks, right? Which is happening in the US. This is already occurred. Like I think that 70 to 80% of the total loan market in the US is non-banks already. Shadow banking system, from asset managers to warehouse facilities to fintech platforms. In Europe, this is much behind. In Europe, 80% is still bank loans. So we still depend very much on banks, but banks have left behind a lot of this middle market, these SMEs market in particular, in the trillions. And so in Europe, you have two big tailwinds. One is the underlying trend that a lot of new loans are happening outside of commercial banks. And two, the catch-up of Europe against the US, which in itself is in the trillions. So like big tailwinds for this market in general globally, and for this market in Europe in particular.
I spoke to Finch Capital on this show about the state of European fintech a few episodes back, and one of the observations was that the US had somewhat been sort of sitting on the sidelines through the pandemic and post-pandemic and the high interest rate period, and that there was more US interest. So that dynamic of a lot more runway of potential private market activity in Europe, because it's still at the moment all sitting with the commercial banks, and you may mirror the US market is a really interesting one. So I can see that sort of propelling the opportunity for you in the sector.
Absolutely. No, that's a big trend. Like a lot of our market exists because of banks retrenching from our market. Our market, the SME market, is difficult to deal with. The ticket size is small. And without automation, digitization is harder to handle. As you know, commercial banks are not particularly good at the IT upgrade, right? So like they're very good at franchise build up, and they are excellent at client management, etc. And for a number of products, they are like unavoidable, and they are the place to go. But for lending and lending to SMEs in the small ticket size on a frequent basis, where there is a self-liquidating nature and the short duration, the loans from the banks are probably not the place to be for an SME.
Yeah.
And so it's only natural that this new market is born.
And you talked about the sort of growth and recognition of the sector and the big guys getting involved, and also being a crowded marketplace. There are lots of other people at a similar size to Fasanara offering a similar service. When you win out on the investment, what is that generally based on? Is it returns of your previous investments? Is it the degree of friction or lack of friction in the digital platform? Is it the experience you've created? I'm just curious, what are the things that are enabling Fasanara to win in the market versus the competition?
Well, is a number of conditions acting at once. So it is expertise, experience, skill sets built over the years, because we have been doing this for 13 years, and in audited track record for almost 11 in open-ended format. So people have seen NAV coming every month for almost 11 years. And so they like that. They like the uncorrelated nature of the return. That is number two. Everybody is able to get a carry out of a beta position in the market by being long something. But it's more difficult to navigate the cycle in credit and in general, the volatility in public markets. And to have done it on a monthly NAV basis for such a long period of time is a testament to the resiliency of the strategy, and also the uncorrelated nature of it, because we have shown a very little correlation to global markets. So I would say experience, and then there is a track record and uncorrelation nature of the track record. Then there is, of course, the technology build-up that recently got also the recognition of Blackstone, which is I suppose it cannot get better than that. And so it's a combination of things. And then at the same time, I believe that institutional investors in particular, they find really helpful to be able to do something good with their money, right? To earn the real economy, not to speculate around. I think that there is not enough of it, not enough, because the institutional investors are the big elephant in the room. They manage over 100 trillion globally, well over 100 trillion globally. And to be able to do something that benefits the real economy straight on is incredibly valuable. And in the past, this was not possible because you missed the bridge. The bridge was not there. Today, technology provides a bridge for them to be able to do that. And so I think this is a very good innovation that comes to. So we typically use the 3D concept, which is democratization, decentralization, and digitization, right? Which we believe into. Is about decentralization of lending activities outside of the usual commercial banks, which are still there. And then there is the democratization of access to funding for SMEs and those individuals which are left behind, right? And so I think that this is really what we are all about. And I think there is a great merit in it. And that's why every year is a bit bigger than the year before.
Yeah. It's a nice link, actually. I wanted to go back to the origination side of this. We were talking about your model and the origination of those loans, because you talked about doing something with value in the real economy. And so sort of that impact investing sort of lens on putting funds to work, the investors' funds to work in the SME space. How do you pick the originators and the loans? Because there must be a whole raft of lending activity going on, and you're not going to just go to, some dodgy payday lender and say, hey, let's package your loans up and I'm going to get institutional investment for you. There must be some filters and some thresholds and a whole process behind what you deem investable and an area that you actually want to get into, but it sits with the company values and those things. So tell us a bit more about how you work with the originators and, source the right loans.
So it's a two-level process. On the one end, you source out the originators. On the other end, then you filter through and you select the individual loans that the individual originators have made available to you. So the first step is onboarding. It requires a due diligence process. There is an ongoing and an onboarding due diligence. And that is done by people that they speak to people and they try to understand if they can trust what they see on the other side.
Yeah.
So that is dealt with by our origination team, which is very skilled, has been in the market for a decade plus. That's what they've lived and breathed for so long now, and they are the market experts. So when they face a platform, they need to do the usual analysis, the analytical in terms of analysis of the loan take, default assumptions and default rates over the years. But beyond that, they also need to come to terms with the governance of the platform, their experience, their skill sets. Very often, these fintech platforms are they miss some bits, right? So you need to see if they have enough to be able to be integrated by Fasanara and trusted by Fasanara, and then act as an originator for us. I'll give you an example. It may be that they are people that they have technological skills for automatization, for digitization, but they lack the credit analytical skills. So they don't know what a loan is, how to get your money back. So it's very easy to give money out. It's more difficult to get the money back. And so you need the right combination between technology and financial. So in the fintech, you need the right equilibrium between fin and tech. And so this sometimes is missing. On the other end, sometimes you have people that they're coming from banks, and so they are great at credit analysis, but they are not good at the technology build-up, at hiring the right developers, putting them together, doing the right data analytics and stuff. So you need the right equilibrium between these two. Another problem sometimes is that fintech platforms are owned on the equity side by venture capitalists. Venture capitalists, they look for exits pretty soon, within 5 to 7 years or 10 years. That creates some perverse incentive at creating too much volumes at the expenses of quality. And so you grow your book very fast, but also the default rate goes up with it. That's not good for an institutional investor that wants to have an uncorrelated stable income over the years across the cycle. So it's a bunch of different things, and on experience can tell you where to look into. Today we have 140 platforms, but we've analyzed more than 1,000 over the years. We have run full diligence packages on more than 400 of them. So it's kind of compare and contrast for us at this moment. We rely on our experience built over the years.
Have you had to offboard a lender yet?
We had over the years at least 15 of them have either gone bust, which is a matter of life, or they've been diluted away or even put out for reasons related to either default metrics, so running into losses, or also a behavioral metrics, not behaving in an institutional grade manner, which is a fit and proper for institutional investors like ourselves, but in particular the large institutional investors sitting behind us and for which we manage capital.
Yeah, it makes so much sense. It's a bit like a traditional wealth manager who's forever reviewing their investment managers and deciding which ones are performing and sort of, changing the mix to optimize.
Yeah. Sometimes these platforms, they play the game of technology and they talk as if they are the next Steve Jobs. But in the end of the day, they do lending. Lending is very old school. lending is about getting your money out, but also getting the money back in. And so, you cannot play a big game without, matching, the basics, the bread and butter of the business. And this is lost sometimes with some of these great minds that they speak a big game, but they don't deliver on the basics.
Well, let's talk for a second about the tech part of fintech lending then. So the digital first approach and what that means, what that advantage really is. And it'd be great to understand what's sort of special about the Fasanara tech approach. I don't know whether it's the stack that you've built the platform on, or is it the features that you've created, or perhaps a combination of the two?
I think it's really the combination of the various elements in it, from the technology part of it, which is the enabler. Without the technology, let's say, you cannot do much because you wouldn't be able to handle millions of loans on a self-liquidating short duration nature, right? And then you would always be put back in cash, and you would have to replenish this cash, and so you would have a huge reinvestment risk. So technology, automatization is necessary to be able to enable like the game of handling such a large number of loans and also doing the analytics of it. Technology, in the end of the day, is not, and don't take me wrong, it's not rocket science, right? Here we are not doing like a ultra sophisticated work. It's like just development, analytics of very, I would say like a reachable level of sophistication. Next to it, there is the experience, the expertise, the skills built over the years, all the bad stuff we have seen and we learned from. And so we don't want to see again. And so we try to adapt and adjust. So that is a very, very big part. That is what is going to keep us in business in the future, because it's learning all the pitfalls and the quicksands around and how to avoid them. Or when you go into a quicksand and you realize you are in it, how you manage it, how you make a turnaround, a restructuring. That is also as important as being careful in lending your money out properly. Is inevitably in private credit, you have those situations in which you run into difficulties. It is all about how you handle it. And that makes the difference between a good performance and a bad performance over the years across the cycle. Yeah. So I think it's a combination of different things. I would say that Fasanara is also very proficient in new technologies. As I said, we also have blockchain market making. We are one of the largest liquidity providers globally also in that space. And so it's all about innovation, pushing the boundaries, and trying to be like these multi-asset and diversified offerings across new technologies. That helps a lot. It may be something that is not so visible today, right, in the eyes of also investors, but it's something that eventually will emerge with time as the institutional adoption of these fintech, but also blockchain comes about.
Yeah, I love that. When I was looking into this ahead of the conversation, I had somehow assumed that we were talking a few hundred loans, but I think you said millions there.
So there are over 3.5 million loans at each point in time running across our books.
Yeah. Yeah. So this is really sort of high throughput scale. And the other thing that you mentioned there, which I understand is part of the business, is the market making on the blockchain. So tell us a bit about that. And is that really completely separate to the private credit business, or there are some linkages there?
There are some linkages, although it's also separate. So we started doing this with our partners, Nikita and Alessandro, back almost 6 years ago. So today we've been trading on it for almost full 6 years of a beautiful performance, very stable as well. All of what the Fasanara is about is this stable income. So it's not just speculating up and down, but really providing this stable income for institutional investors. So we seek market neutrality in what we do on the liquidity provisions on the blockchain and on cryptocurrencies. So it's been a very good run. And of course, this is like a pool of assets that provides performance, right? So it's pure hedge fund style. However, the link between the two sides of the business is the tokenization of real world assets. So today, the two souls, they speak a little to each other because the fintech happens in hard currencies for the most part. And crypto happens on these entirely new financial rails with the cryptos. However, more and more over the last few years, there have been attempts at tokenizing real world assets, so tokenizing pools of loans, in our case, bring them on chain for better liquidity, accessibility, tradability, etc. And so Fasanara has been involved also in this tokenization of real world assets. We have already launched a few things in that, in partnership with Signum Bank is one. And then another one, we did it internally with another platform that we seeded called Antango. And we are doing new things as we speak as well. We are doing also a money market tokenized fund as we speak, which I think gets announced today. So like we're very experimental. One of the mantra that I really very in love with is experimentation over experience, right? Exploration over exploitation.
Yeah, I like that.
So what I mean by that is that you should always push the boundaries and forget a little bit about your experience that will tell you to stick to the narrow path and venture outside of it and try new things. And then things will form up at their own speed and will make sense later on. So this is exactly what we've done with the blockchain and more recently with the tokenization of real world assets.
Super interesting. So just listening to that, so my takeaway would be that you've been for some time market making in cryptocurrencies, so presumably sort of Bitcoin, Ether, other things, and that you've also tokenized bundles of loans. And so is that, have you created your own token that's a bundle of SME loans that's now available on the crypto platforms? Is that sort of how that side of it works?
So both of them. So on the one end, with the Nikita and Alessandro, we trade the top currencies, the top cryptocurrencies in market neutral fashion. So market making, market neutral. And we produce a good return by just trading in and out, which means really basis trading, cross exchange trading and stuff. So arbitrage opportunities, market neutral. This is pure hedge fund, delivering returns to investors for a long time in a very stable manner. Next to it, there is the tokenization of pools of loans, using the blockchain as a chain on which to put these pools of loans. And we have attempted a few different things in that space already over the last 2-3 years, and they are up and running. And they are effectively tokens that if you buy the tokens, you have access to this pool of loans and the yield that emanates from this pool of loans. As I said, it's still experimental because I cannot claim that there is any scale to it. Differently than what I can say about the fintech lending, which is in the billions, and the crypto stuff, which is in the hundreds of millions. So that is already scaled up and veteran status, very established. The tokenization of real world assets is not. It's still experimental. We are still playing around with it and trying to find the right fit.
Have you put any of those tokens onto any of the crypto exchanges, or have there got your institutional investors invested in them at this stage?
No, not yet. So there are investors invested in it, but not at scale. Yeah. They are on chains, of course, in different chains. One is on Ethereum, the other one is, I think, is in the various other chains. But I cannot claim that there is any institutional scales to it yet.
Yeah. Bless you. Thank you. It's a fascinating direction for the business. And again, a bit of a crossover with some of the conversations I've had on this show in recent months as well. We're leaning into real world asset tokenization, more on stable coins, actually, I think was the conversation with Chin and Louis. But this concept of tokenizing real world assets has been out there for a very long time. And actually in my consulting capacity, we did some concept work 7 or 8 years ago around tokenizing wine and art collections or holiday homes and providing fractional access to those. And some of those things are really starting to become real. It's taken longer, I think, than many folks had expected, but you can really see the potential. So let's look ahead for a few minutes. Lots of exciting things going on. When I got into this conversation, I thought we were just going to talk about fintech lending, but we've been talking about blockchain as well, and the convergence and overlaps. And so you're involved in all sorts of complementary innovative activities to drive the Fasanara business. What's next? What do you see the opportunities and challenges ahead for Fasanara?
Well, so the target is to scale up. Right. So today we manage 4.5 billion. We want to get to bigger amounts because our technology supports that. So we have already existing capacity to manage a lot more than that. So the focus is on capital formation and creating new institutional investors to do the same. So just scale up is the near-term target. And this is across all of our strategies, from the fintech to the blockchain to the other things we do, sports lending. We also lend to football clubs, for example. We have a venture capital business as well that does investment into early stage tech companies. So all of that is a very kind of old. Let's say we move from almost 11 years of track record on the fintech lending funds to almost 6 on the cryptocurrencies trading market neutral funds, to almost 5 on the venture capital funds, almost 3 on the sports lending funds, etc., etc. So that is ripe for scale up. And then, of course, the challenges are the same challenges as every other asset manager, that we need to see a proper cycle to test what we are doing properly. So a proper stress test. There's not been one since the GFC, the global financial crisis. There's been the European crisis, there has been the pandemic, there has been the inflationary period, but really we need to see a proper credit cycle to test the strategy properly. I think that those moments are moments of validation, without which a proper scale up will never happen. So those are moments of validation in which we could see if some other asset managers are swimming naked, as they say, and it's only when the tide turns that you can see that. And so we look forward to those moments of validation. If a memory goes back to GFC, that was a moment of validation for a lot of important players, from Carmignac in Europe to Bridgewater in the US to Bluecrest as well. They all accelerated the speed of growth by going through those moments. And so I think it will be no different this time. And it will be a matter of years before we encounter one and we can prove our worth during it.
Really interesting. GFC as a moment of realization. It was also sort of a moment of disintegration for quite a few players as well. But these are the moments in the market that really filter out.
And it can always go wrong, right? Yeah. It's not a one-way road. It can go both ways. But without validation, it's difficult to have a proper adoption at scale and the proper mass adoption.
Yeah, and you said that your venture arm is lending to football clubs. Again, I don't know how interested that'll be to the audience. I don't know whether you can say which ones, but does your supportive preferences come into it?
Yeah, so we have a great partner at that as well. In this case, it's a company called Tifosi, and they're a great advisor and great partner. And we originate loans together. They've been in business in football for years. One of the top sourcer is the CFO of Juventus for over 20 years. So they bring to us investment opportunities. We analyze them on the credit side. We decide or not whether we want to direct lend. And we do it backed by transfer receivables. So our sports is really doing a squad-backed financing. So we do a loan backed by transfer receivables. Not technological, it's just direct lending, but very innovative. As for us at Fasanara, it's important whether or not we have the right combination of innovation and technology. Sometimes we have only one of the two, but we need to have one of the two for inclusion into our family of products. That's very important to us.
And a transfer receivable is a receivable based on the transfer of players, is that right?
So as a small team, you sell a player to a larger team, and we would lend you money backed by those transfer receivables for a very low LTV and a very nice set of conditions that would create a strong downside protection. The market itself for transfer receivables is quite safe, relatively speaking, of course. And on top of it, you put all of your collateral packages and downside protections and covenants, and you end up with a diversified pool of those loans that produces double-digit returns, unlevered, so without the need for leverage. And we've been doing that for almost 3 years. Yeah. We already lent out more than $250 million, and more than 20 clubs have been funded by Fasanara, and we manage today more than 120 million at it. So still early stages, but we think this fund can grow to bigger amounts. The reference market in this case is not as big as fintech. We're not talking multi-trillion. We're talking probably a couple of billions, but it's still relevant and still is innovative. And we like the challenge of doing something new. Apollo, as a month ago, launched a similar fund doing receivables-backed financing with the help of Citibank as a lender. So the market is interesting, but the way we understand it, they just started with a fully dedicated fund, whereas Fasanara is at it for almost 3 years. And so this again is a testament that probably we are onto something.
Yeah, and possibly slightly ahead of the pack. So another market segment that I didn't know existed, transfer receivables, and one that seems to again receiving some validation from some big names recently, based on what you just said. If Citi and Apollo are doing something. Are you building your business in the US? Is that, or in other geographies?
We have the headquarters is London, but we have a few years ago opened an office in Amsterdam. We are opening an office as we speak in Abu Dhabi, which should be open in Q1. And we are soon going to open an office also in New York. And New York is an area of expansion. New York, or the US, is an area of expansion. We already operate across the States with around 10 platforms over there. But we have plans to expand our operations over there as we welcome more and more investors from the US.
Yeah, very good. Okay, well, lots to keep you busy. So we could talk a lot longer, but we'll run out of time. But just a couple of things to wrap things up. Your thoughts of advice for audience, those who, some of our audience are thinking about or have just started fintechs of their own. So you're over 10 years into this and have some scale, but Anything that you would give as advice for the entrepreneurs out there?
Well, definitely, I would say that there is a lot to learn from what worked and what didn't work over the past almost 15 years of fintech lending that is already visible and investigable by us. So there is the second mover advantage. I think people that today they launch new ventures in fintech, they can look at what failed and learn from it. And there is a lot of case studies for it. And so, I would really encourage to take advantage of this second mover advantage. There is nothing that tells me that the fintech trend is not entrenched and bound to stay. Every year is bigger. The players are sometimes new, but the trend itself is stronger and stronger. And it is the same as it happened between bookstores and Amazon, Uber and taxi companies, etc. It's the same trend of digitization, which is better handled by challengers instead of incumbents. And the partnership with incumbents are more and more frequent because incumbents do realize that that is the way to go. So I would only encourage you to launch new ventures, learning from the past, and copy some business model, adjusting them, be incremental, and then, of course, exponential after that. But definitely there is a lot to play with. It's an incredible moment in time in history where there is the adoption of these new digital technologies. If they can think of off-ramp on ramps on chains as well, it's great because that is coming up. Regulation is going to be more friendly for that as we go by. And so definitely the also combination between fintech and blockchain is the one that I would dedicate time into if I were.
Thank you. I mean, there's quite a lot there. So, and I absolutely get that the real world assets and the blockchain convergence opportunity, barriers to entry for would-be entrepreneurs based on technology and the tools that are out there about as low as they've ever been. So super exciting. The advent of AI in everything and how that can co-pilot an entrepreneurial journey. And there are various stories, circulating on LinkedIn about fintechs that don't have any staff at all. They're just run by AIs, and it's the direction of travel that we're going on. And then the other point you made there, which I really like, is just learning from history. And I think it was Michael Jackson who became the best by saying that learn from the greats. And there is something there. I mean, you're looking at the incumbents, looking at the firms that are top of the pile, and there are some hugely valuable lessons Absolutely. That anyone can pick up.
And I think there are also valuable lessons in learning from the failures, right? Because, it's all great to look at the big guys and the guys that made it, but you can never know the degrees of presence that they could play with. And also the luck factor was a huge one, right? In a chaotic environment that things happen. But learning from the failures, that is a more mathematical, certain endeavor where you can clearly see what really didn't work. And for what worked, there are always many reasons. For what didn't work, there is always one reason. And so you can isolate that and try to improve from that into something that works. And there's a clear product market fit. And that will, I believe, increase your chances of success from a probabilistic point of view.
Yeah, echo that. I mean, I couldn't agree more. And we were talking briefly before the show about what you're reading. I think you called it random reading, actually. I think it sounds like you have quite a reading list. Anything particularly that you're reading or indeed listening to currently that you'd recommend?
I like to read a lot and I learn from everybody. Today is such an incredible moment in time in history because you can literally open your YouTube or read or listen to a podcast, informative podcast, and learn so much from it. Read a book. And read a book is still at the top, in my opinion, because the writer has given thought to how he wants to put down his thoughts in order, right? So he has given his best. So for me, I read a lot about finance, history of finance, technology, of course. Today I'm reading not today, but these next few days I'm reading books by Tim Marshall, Prisoners of Geography and the Power of Geography, which speaks about how important geography is still in detecting some trends and things happening across the globe. I'm fond of the Austrian School of Economics, so I keep on reading about that. I'm fond about the Stoic philosophers, so I keep reading about that all the time. Compared to robots and algorithms, we have a very frail memories as human beings. So I sometimes read the same stuff that I already read in the past as if it was the first time. And so I also do that, striving to memorize, I would call it a bit random because it moves in different directions and then without a specific design in mind, just enjoying it.
reading the same book twice. It's a bit like watching the same movie a few years later, which I've found that I'm able to do, which is probably my early stage Alzheimer's kicking in.
Sometimes I've got such a bad memory that I look at the same movie twice and I only realize I watched it already half into it, you know?
Yeah. And these days, of course, reading and listening, there's a bit of a crossover, what with audio books. And the latest version of this I've discovered is that if you upload or link the text version of the book to, I think Notebook LM does this, it will create an audio summary. It creates a sort of podcast of it. I actually gave it one of these episodes, which was an hour's episode. It turned it into a 6-minute podcast with 2 synthetic avatars, which a number of people told me was more interesting than the show itself. So that one's out there. I know at least one person who's actually told me they don't read books anymore. They just they get them summarized by the AI.
Yeah, the attention span of people is narrowing down to alarming levels.
Yes, it is. It is indeed. Okay, so we're going to time out, but Francesco, thank you very much. If folks want to find out more about Fasanara or get in contact with you, where should they go?
Fasanara.com is our portal, and you find a lot of information about us over there, a lot of also media content.
Yeah, thank you. Well, lots of great insights and stories in today's episode. And once again, thank you for your time. And I'm sure the audience are going to love this.
Thank you, Tony. Thanks again. Great to be here.